Hello traders, Gary Wagner here just after 12 noon in Honolulu, 6 o'clock in New York. It is Tuesday, second day of June 2020, and this is the daily report for gold and silver. We had strong drawdowns in the precious metals markets as a whole, that complex. We had higher pricing in U.S. equities. That tells me there's absolutely a disconnect between the fundamentals that are going on in the world and current pricing of equities as well as safe haven assets. Consider this. We're just getting out of a global pandemic, and as we got out of that pandemic, we now have protests and riots in the streets of America that are destroying many retail operations that were the hardest hit by the pandemic. On top of that, you've got the renewed tension between China and the United States regarding the trade war. In fact, the Phase 1 agreement that they worked so hard to achieve seems to be unraveling, according to the news we read yesterday. Nonetheless, we had gold trade off sharply. We had equities move up. Let's take a look at our current pricing. We'll talk about our trade when we pull up our technical studies. The precious metals complex did trade lower today, and that in light of a weaker U.S. dollar, fractionally weaker. We are looking at August gold futures down 16.20, closing at 1734.10. What is important to us, of course, is the low today. The low today came in at roughly 1728. You can see that on the lower left-hand side chart. This is a short-term 240-minute chart, and you can see that the 78% retracement, which comes in roughly at 1728.40, is precisely the low of the day. The market did recover slightly, and as I said, is down $16. When we look at spot gold is currently at $1725.90, down $12.93. Platinum lost $30, a total of 3.37%. It is currently at $870.70. And palladium also lost today, but only about 0.3% at $1981.40. Silver had a pretty dramatic decline, giving up 2.32%, 43 cents, and currently tracking at 1839. Let's take a look at our technical studies. There are a couple of ways to actually put in upper and lower level trend lines. I'll show you a couple of examples. This first example is the tightest of the examples, looking at the market as in essence having a flat top, meaning that we have stalled at a series of highs that come in roughly at 1770. But we also can see and say that we have had a series of predominantly higher lows since April of this year. But the key is the market is genuinely trading sideways in a defined range. We can say that that range on the low side is about 1675, and on the high side it is about 1775. So it is about a $100 range. But we've seen that we have had difficulty, or gold has had difficulty, breaking above this upper level resistance line. That being said, we do get a different view when we look at this daily chart, where we have started this compression triangle back on April 1st when the market did trade and break below 16. You can see that right here, and then we have attached that to the low that was achieved just about a week ago when market forces took gold pricing to just below 1700 briefly. Our upper level resistance line is now on this particular chart matched from the two highs. First, the yearly high, and the second one is 1775 right here. So we can honestly say that we have seen this market trade within a defined range, this being the major part of the range, the low to the high, that first wave. And then from there, we had these series of higher lows and lower highs, as you can see right here, which was the second highest price point that gold had achieved since trading to 1788 a little bit earlier. However, at that point, it makes an extreme low right here. This would be the conclusion of wave 4 on our Elliott wave count when the market actually traded below 1700. I believe the low that came in here was about 1685. And traders, that was the beginning of the rally that we're currently in. Even with this down day that has come in, you can see that we saw the market really trade effectively off those lows and trade to these highs at about 1760, call it. Today's high was 1757. So the key is, if it continues to trade under pressure, it should have a much higher low than the previous low. And my sense is, when we take a look at the big picture, which contains three primary reasons I believe that gold will move up. First, the massive budget deficit and tremendous stimulus that has been provided by the U.S. government, adding to the debt of our nation. And that, of course, was due to the second reason, which is the global pandemic that is currently at play. And then lastly, renewed tension between the United States and China in terms of the trade agreement as Phase 1 even begins to unravel. Those three things collectively should be highly supportive of gold pricing. We will maintain our current long as well as our stop. This has been Gary Wagner, wishing you, as always, good trading. We will talk to you tomorrow for the next daily update and review. Bye-bye.